Okay, confirm you can hear me, please. Confirm you can hear me.
Loud and clear.
Okay, a very warm evening to all of our very amazing members of SPE Abuja section. Yeah, month in, month out, right from January, we have been doing the monthly technical session where we disseminate technical information for all of our members. And it's just 1 month and we are done with 2025. So let me start by saying thank you for always attending our events. Thank you to our leaders, section chair, the programs chair, for ensuring that every month our members enjoy amazing technical sessions. So please, for the 8 participants on the call, today's session is very, very interesting for us as you understand the directive of the government as regards new tax laws which we implemented from January 2026. So the section has brought this amazing session, which is on the theme preparing for Nigeria's 2025 tax reforms, 10 strategic priorities for oil and gas companies. So you are at the right place. Please share the meeting link to your colleagues, share the meeting links to your friends, share the meeting links to even non-SPE members who you feel should learn about Nigeria's tax reforms. It's going to be a very, 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 very brain stimulating session, and I will be so pleased to have so many members join. My name is Ofofono Akbar. My pleasure it is to serve as your moderator and MC for today. So please, I'll leave you for about 2 minutes, and by a few minutes, I'll come back and we'll continue the event. So please share the links on your groups, share the links everywhere. Let's talk about tax today. Thank you very, very much. Okay, once again, ladies and gentlemen, welcome to our November monthly technical meeting. Today's event is themed Preparing for Nigeria's 2025 Tax Reforms, 10 Strategic Priorities for Oil and Gas Companies. Today, we are so pleased to have the lead tax strategy, treasury, and risk E&P company, the one and only Easy Egbe Aibangi. A very warm evening to you, sir, and thank you for joining us today. I'll continue the event by sharing a few safety tips or announcements. I'd like to appeal that please, for the course of today's event, if you're not speaking, we leave your microphone on mute. Also ensure you raise your hands if you want to speak, and of course, you'll be given the opportunity to speak. Of course, we also appeal that if you want to send a question or a chat, please use the chat button on your screen. And so you can still hear your fire alarm with your headset and you understand the security situation in the country. Please be alert and aware of your environment. Ensure you stay safe. Ladies and gentlemen, at this juncture, I'd like to continue by recognizing some amazing leaders that have joined us on the call today. I'll start by saying a warm welcome to our leader, the champion of excellence in SP Abuja section, the one and only engineer Ikechukwu Okafor, PhD, our section chairman. A very good evening to you, sir. Confirm you can hear me, sir.
Yeah, I can hear you. Good evening, everyone.
Thank you, sir, for joining us. Thank you, sir, for your leadership in the section. Also on the call, ladies and gentlemen, is the amazing programs chairman of SPE Abuja, Professor Kafayat Adeyemi. A very good evening to you, ma'am.
Good evening, everyone on the call. Thank you,
Thank you, ma'am. Thank you, ma'am, for joining us. We welcome all of our senior members on the call, those that might not want me to recognize them. We see you, we welcome you on the call. Welcome all of our student members, all of our senior members, professional members. We see you. Thank you for joining us. We celebrate you. We also say a warm welcome to our speaker for today, our facilitator for today, a tax expert. Of course, the lead tax strategy, treasury and risk, A&P company, Izinegbe Aibangi. A very good evening to you, sir. Confirm you can hear me, sir.
Good evening. I can hear you loud and clear.
Thank you, sir, for accepting to share your wealth of knowledge to SP Abuja section. We celebrate you. So, ladies and gentlemen, we switch gears immediately to hearing from our leader, the one and only champion of excellence in SP Abuja. Ladies and gentlemen, over to you. Help me welcome Engineer Ikechukwu Okafor, PhD, section chairman, as he gives us his welcome address. Over to you, section chair, sir.
Please confirm you can hear me and yeah.
Yes, sir. We hear you. We see you, sir.
Okay. Good evening, everyone. Welcome to the November 2025 MTM of SP Abuja section. Today, we have a speaker in the house who will be talking about the essentials, the important details in and around the tax reforms and how it would affect asset valuation and all that around the energy and E&P industry. A very key topic, I must say, a very pressing one that needs us to be here to listen. It's a pleasure to welcome you all to that meeting, the November 2025 monthly technical meeting of SP Abuja section. In SP Abuja, we carry on the torch of excellence, sharing technical knowledge as aligned to the core value of SP International. We will do no less but to keep bringing you amazing topic like this that adds value to your daily professional pursuit and your career development. We have a speaker who is well versed in this area. He is a lead around tax reform in an E&P company, and so it will be a pleasure to listen. If your friend is not here or someone who should be here is not here, I think this is the right time to call them in, because some of these kind of critical lectures are something that we take home and we build on, and it profits us beyond our wildest dream. So on that note, I want to welcome every one of us on behalf of the board of SPA Abuja section, and we say thank you and welcome.
Thank you so much, Section Chair, for your amazing remarks. Thank you so much, sir. Ladies and gentlemen, Section Chair has already started the event, and so we continue. Of course, Nigeria prepares to implement a comprehensive suite of tax reforms in 2025. The oil and gas industry stands at this pivotal moment. Of course, our technical lecture is designed to help professionals, operators, and policymakers cut through the complexity and understand what truly matters for business continuity, investment decisions, and long-term value creation. This session will break down the top 10 reform areas that will directly impact joint ventures, production sharing contracts, risk service arrangements, marginal field operators, gas value chain players, and emerging energy professionals. Of course, we ensure to understand that you will gain clarity on the new provisions, the fiscal shifts, and compliance obligations shaping Nigerians' evolving landscape. Ladies and gentlemen, introducing our speaker for today. He is a finance and tax executive with over 20 years in Nigeria's upstream sector. He leads tax strategy, treasury, and risk for a leading E&P company and has advised on production sharing contracts, joint operating arrangements, and complex funding structures. He guided his company's first international investment grade credit rating, expanded liquidity options, and closed capital financing arrangements. His industry work includes OPTS fiscal advocacy, input on national tax reforms, and impact assessment of the Nigerian Tax Act 2025, Petroleum Industry Act, Finance Act, and other legislations. He also led disputes resolutions and transfer pricing reviews and supported buy-side M&A diligence. Before industry, he worked with PwC advising multinationals in the oil and gas tax practice and edited the firm's periodic tax bulletins. Easy holds a master's in development finance from Stellenbosch University, Cape Town, and is currently a doctoral candidate at UB's Geneva with research in resource finance infrastructure for gas pipeline development. He has completed programs at Lagos Business School, London School of Economics, and Duke Fuqua Business School. He's a fellow of ICANN, CITN, and a member of CIMA. He is married with children. Ladies and gentlemen, introducing our speaker for today, Izinegbe Aibangi. Over to you, sir, for your lecture.
Thank you very much for that introduction. Please confirm you can hear me loud and clear.
Yes, we hear you loud and clear.
Thank you, and good evening, distinguished members of SPE Abuja section. It's really my pleasure to be in your midst today, however, virtually. I want to especially thank the section chair, Engineer Okafor, PhD, and also the program chair, Professor Adeyemi, for all the support and your invitation to this very laudable initiative, this technical session. This evening, we would unpack the Nigeria Tax Reforms 2025, and specifically we'll be looking at what we call 10 strategic priorities that every oil and gas company needs to pay attention to before the implementation of the acts come 1st of January. We'll try to finish within the allotted time. I understand we have 30 minutes, and after which we'll give room for Q&A. But please, by all means, put your comments in the chat room, and we can address some of them as we go. I always like to frame taxation in the oil and gas industry in this way. Apart from our cash calls, tax and royalty are the most significant expense we have in our books. And so if we are able to understand and hopefully manage our tax bill, we'll be making our shareholders and investors happy. And if we can make our investors happy, we ourselves as executives will be happy. And so that's the mindsets we bring into reviewing what 2026 holds for us with regards to the tax reforms. And I must say that these reforms are the, okay, I'm just saying this. Yeah, so these reforms are really the most significant fiscal changes we're seeing since the PIA in 2021. Because they touch all aspects of our business. So whether it's our business structure, royalties, capital allowances, gas incentives, it reinforces some of the provisions we also have in the PIA. So in case we see, some things that are quite familiar, they are coming from the PIA. Okay. Yeah. So what we are going to do would be to look at overview of the Act, and then we can dive deeper into some of these priority areas. So the NTA 2025, tries to consolidate Nigeria's major tax laws into one modern framework. The president signed about 4 legislations in June this year, and the NTA is just one of them, but it's the most important, I have to say. But the other acts are the Nigeria Tax Administration Act, which just deals with compliance requirements, filing obligations, things like that. Then we also have the Nigeria Revenue Service Establishment Act. That one just changes FRS to NRS. That's their new name. And then, of course, the Joint Revenue Board Establishment Act. That just gives legal backing to certain tax structures. But the purpose of everything is to align all our tax laws together and put everything into one unified fiscal system and remove any conflicting rules. Next slide. Yeah, so these are just the other tax acts. There are 4 in number, but our focus, of course, would be on the NTA itself. Next slide. Just go back one. Okay, so by way of setting the stage, we've come a fairly long way since PIA in 2021. Over the last few years, we have seen passage of Finance Acts by the National Assembly. Those have implications, of course, for us in our industry. We've also seen a number of important presidential and executive orders signed by the president, not least the non-associated gas incentives. We've also had regulations from NUPRC and FIRS. But these tax reforms signed this year basically completes what I would call the full tax harmonization. And by 1st of January next year, everything becomes operational. So the runway for us is pretty short. Next slide. So this is the layout of the NTA itself. It's about 9 chapters. It reshapes, like we said, tax administration. It kind of organizes the tax rules into a logical flow. Touches general income tax, CIT, our own upstream operations taxations, where you have our hydrocarbon tax, royalties, and so forth. So the idea is that it's supposed to be cleaner. It's supposed to be easier to understand. The language is, slightly more readable, unlike previous tax legislations. So what this means is that we have to give attention to it. What are some of those changes that we would be looking at this evening? Next slide. So these are just schedules attached to the act. I'm sure these slides are going to be circulated, and so we can always refer to this if we need any particular references to sections of the act. Next slide, please. So the act recognizes some of the very common upstream arrangements we have in our sector. And we know that in Nigeria, all hydrocarbons are vested in the federal government, and the federal government invites private sector operators to exploit those resources and share rewards with the government. And that is primarily done through contractual arrangements. So these are some of the 5 most common that we have in Nigeria. And we know that taxation follows the contractual arrangements. So we have JVs, PSCs, of course, risk service contracts, marginal fields, and of course, gas. Next slide. Yeah. So I think, this is all just a recap. We know what JVs are about, primarily driven by MOUs, equity-based between the government and the IOCs. They are the originator of oil and gas production in Nigeria. The typical fiscal regime that a JV operation, has is the PPT, which we are familiar with. And if it has converted to PIA, then hydrocarbon tax and CIT. Now, for production sharing contracts, that came, I believe, in the very early 90s when the government began to consider how to limit its exposure, to dry holes and, unsuccessful exploitation. And I think we inherited this from Indonesia. The contractor party bears the cost, and then if there's an upside, if there's commercial production, it recovers its cost, through cost oil, and it shares profit oil with the government through an NNPC those days, according to the profit oil split. Most of them was deep offshore, so it was PPT and DIPSA, the Deep Offshore Inland Basin, that was applicable. Rig service contracts, here the contractor funds the operations, but it doesn't have title to the oil, and so it just gets paid in fees. And that's primarily CITA, company's income tax. Marginal fields, that came about because the government wanted to encourage indigenous smaller players, mid-cap companies, to develop some of these underdeveloped acreages, previously held from the IOCs. And they got a number of incentives, but they are mainly primarily PPT as well. And then gas development. The government right now is very focused on non-associated gas. The decade of gas, Nigeria is a gas province. The decoupling of fiscal incentives for gas from oil is really the government's focus. And there's a lot of activity going on in there. And I think the implication of all this is that the arrangements that you have determines the type of tax rules and incentives that would apply to you, even under the NTA. Next slide. So these are the top 10 priorities that we're going to cover. Residency and structural risk, capital allowances, royalties. We are familiar with a number of these, but we'll see what the NTA has to say with respect to our operations. Next slide. Now, The residency and structural risk, this looks at the kind of business structures that we find very commonly in our sector. You know, we are international in scope, and a number of our group companies might be involved in activities like trading of our crude, shipping, asset or equipment holding. So maybe you have a private or rather a corporate jet, you know, that is held in an affiliate company, or maybe financing. Now, some of these entities are registered offshore Nigeria, in what we call tax havens or tax advantageous jurisdictions, maybe a Bermuda, a BVI, you know, Jersey, and so forth. Now, some of that is done for tax reasons, some of that for, you know, commercial reasons. Now, what this particular part of the NTA is saying is that the FIRS or the NIRS right now can deem a foreign affiliate company to be a Nigerian resident based on something called effective place of management. And if you go to the next slide, what this means is that if the Nigerian authorities consider that this foreign affiliate, maybe registered in the BVI or Bermuda, is actively controlled from Nigeria, maybe its board of directors meet in Nigeria, or its strategy is being implemented from Nigeria, or even its accounting or its audits is done from Nigeria, then the tax authorities would assume that company, even though it's registered offshore, should be liable to all the Nigerian tax obligations. So whether that would be your CIT 30% or this new development levy of 4%, and it's going to have to file regular tax returns like a normal Nigerian company. So this is targeting not necessarily where the foreign company is registered or incorporated, but where its key decisions are coming from. So that's what effective place of management covers. And, you know, like I said, because we are very international in scope, this is a big exposure for us because it can easily increase, you know, the group tax costs of any oil and gas entity. Next slide. So closely related to that is this concept of a 15% minimum effective tax rate. So what this means is that if that foreign affiliate is paying an effective tax rate of less than 15%, say it's registered in the UAE, in Dubai. The UAE corporate tax rate right now is about 9%. If it pays 9% of its profits registered in Dubai, the Nigerian government is saying that the Nigerian parent company must pay up the remaining 6% to bring that effective tax rate of the Dubai company to 15%. So this also increases not just compliance costs, but it begins to question, you know, the I would say the commercial reasons behind setting up some of these entities offshore in the first place. If you're not going to be able to legally manage your tax bill, then really what's the reason for it anymore? Next slide. Next slide, please. Okay, so the next slide, you can go back one, please. The next slide is capital allowances. The NTA, I would say it kind of liberalizes capital allowance claims for companies in our sector. Even though the rules are tighter, they are clearer compared to before. I think one thing that we'll notice immediately is that for companies in our sector, you know, when you acquire an asset, you can claim it 20% per year over 5 years as capital allowances. Now, year 5 before now, you couldn't claim 20%. You could only claim 19%. and retain 1% in the books. But this NTA removes that 1% retention, so you can claim the full 20% in year 5. So that's good. It also clarifies the fact that PSE operators can now claim capital allowances post-conversion. So this removes that lack of clarity as to whether it was NNPC or the contractor party that could claim capital allowances. This says no, it's the COP. And then there's something else that I think is important here as far as capital allowances is concerned, something called relevant interest. Now, assuming you have two companies, company A has 60%, company B has 40% equity share, but there is a carry arrangement between them. So that means company A is bearing all the cost of company B's 40%. Now, what the NTA is saying is that even though company A is incurring the 100% on behalf of both parties, it can only claim up to its relevant interest as far as capital allowances is concerned. So company A can only get 60% of whatever the capital allowances are, and company B, who is being carried, would enjoy 40%. It tries to protect minority equity holders in assets, and that's the benefit of this. So irrespective of whether an entity is being carried, it can still enjoy capital allowances. And then the final point here is that VAT and import duty are so critical now. If you incur any capex and you cannot demonstrate you paid VAT or import duty on it, you would not be able to enjoy capital allowances. Next slide. Royalty is also another very important point because for certain sections of our industry, it increases the royalty cost. If you are an unconverted lease and you are still paying PPT, I understand before now, we only pay PPT on our production. It was only those who converted, I believe, who paid both on production as well as royalty by price. But the NTA levels that field and says, even though you are yet to convert, you are a PPT company, you now have to pay royalty by price. And then royalty administration has also moved from NUPRC to NRS. So I think we can expect more aggressive dealings compared to how it was with NUPRC. I mean, FRS are always more aggressive. And then it introduces monthly and annual filing of royalties. But that's not the story. The story is that the monthly filing has to be done 14 days after the month of production, not just filing, but payments. Now, 14 days after month of production is very early for a number of oil and gas companies because you might not even have lifted, talk less of selling and realizing the crude. But what this means is that you would have to pay royalty nonetheless very quickly, and you have to do that out of pocket. So that's a high risk area. Oh, wow, okay. Yeah, and then one final thing in there was that for royalties, the tax authorities can actually go back 10 years to re-audit your royalty filings even after you have done reconciliations with NUPRC. That's a big area there. Next slide. So transaction tax cost, this looks at withholding tax and VAT. Next slide. So what this says is that every payment emanating from Nigeria, particularly to foreign vendors, now attracts withholding tax. Whether or not that vendor stepped foot into Nigeria makes no difference. Those days, we used to have a concept called permanent establishment, whereby if they have a setup in Nigeria, then they are liable to withholding tax. This says no, irrespective. And I think this is quite practical and interesting because say you send your team members in your organization to a training in Dubai. Now, that training is completed 100% in Dubai, and they come back to Nigeria, and the Dubai company sends you its invoice via email to Nigeria. This NTA is saying that you have to withhold tax on that payment to the Dubai company, even though they never came into Nigeria. So that's quite interesting. And I think the ramification of this is that it's going to create some kind of friction with some of our foreign vendors. You know, many of them like to do what I call net of tax arrangements in their contracts. And so that means you might have to bear that withholding tax expense, and that increases your OPEX. Next slide. So for VAT, this is similar to what we talked about in capital allowances. If you incur an expense and you cannot demonstrate that you paid VAT or import duty on it, the tax authorities will not allow you claim a tax deduction. So sometimes it's not really that you didn't pay the VAT or the import duty, but if you cannot demonstrate by way of proper documentation, you lose the right to claim a deduction. Next slide. So this talks about industry taxes on profits. Now, a lot of this is lifted from the existing PIA. So for hydrocarbon tax, PPT, CIT, there's really not much that is new. If you go to the next slide, for example, the NTA recognizes the fact that we have, for upstream companies, 3 main fiscal regimes. If you've converted, that means you are under the PIA, and then you pay hydrocarbon tax and CIT. Now, if you've not converted and you are a typical onshore or shallow water company, then you pay only PPT, which is the 85% or 65.75 if you are your first 5 years. And thirdly, if you've not converted and you are into deep water, you are a PSC, you pay the 50% deep offshore rate. Next slide, please. Yeah, so this doesn't, there's not much new here. The only thing I would mention here is the 4th bullet point there. The NTA is suggesting that going forward, deep offshore companies are now liable to hydrocarbon tax. There used to be an exemption for deep offshore companies in the PIA as far as hydrocarbon tax was concerned, but the NTA has deleted that portion. However, the NTA does not prescribe a tax rate for hydrocarbon tax for deep offshore companies. So legally, they are liable to HCT, but vitally, they have 0 HCT to pay. When we approached the Fiscal Reforms Committee, that's Mr. Oyedele's team, they admitted it was some kind of printer's error and they were going to rectify. But the law as it stands today, deep offshore companies appear to be liable to HCT. Next slide. So there's a new tax coming up, which is this 4% development levy. It's one of those, it streamlines some of the previous taxes we pay separately, like tertiary education tax, NASENI levy, police trust fund. So those are now gone and they are replaced by this 4% levy. Now, this 4% levy is going to increase everybody's tax bill because it's ballpark marginally higher than the combination of these taxes is replacing. And then if you are a PPT company, you're still under the old PPT, you can get a tax deduction for it. But if you have converted, there is no tax deduction. So PPT companies are slightly better off under this new development levy. Capital gains tax, we might have seen it in the news, I believe it was last week. A lot of investors are not happy that the CGT rate is moving from 10% to 30%. And I believe the Honorable Minister of Finance said that we're going to maybe take a second look at it. if you are a seller divesting an asset and you make capital gains on that, it's going to be at 30%. So that's not very friendly. And the justification from the government side is that they wanted to remove this arbitrage between passive or investment income and business profits. Why should one be 10% and the other 30%? But the investors are saying it's reducing Nigeria as a desirable investment destination, particularly oil and gas, where all our bills are very high. Next slide. So D&A fund, this replicates what we already have, I believe, in section 233 of the PIA. But what this says is that if your funds are domiciled, at a minimum 30% of your funds are domiciled with an approved Nigerian bank, then you can get tax deductions on those contributions, when indeed you start making those contributions. The only thing is that it must leave your coffers into an escrow account with an approved Nigerian bank. And I know that the industry is waiting for NUPLC and NRS to issue guidelines as to the modalities. Who are these Nigerian banks going to be, and so forth. So I think it's just watch this space. Next slide. So this priority 7, it's maybe one of the more complex parts of the act because it puts different things into one. But if you move to the next slide, the act follows the PIA by saying if you want to play in upstream, midstream, and downstream, you have to create separate companies for each stream because the rules are not the same. However, if you are something called an integrated strategic project, then you can use one company to operate across the streams. An integrated strategic project, ISP, is a company that has an upstream product which it produces or refines for the purpose of selling to the domestic market. And a typical example might be, say, maybe an NNPC that has an upstream business, but is also, developing the AKK gas pipeline, which is midstream. Whatever cost is incurring on that midstream infrastructure, it can offset immediately against its upstream profits. So it's some kind of incentive. You don't need to wait until the midstream revenues are coming in years later. You can offset it immediately. So that reduces your taxable profits and your tax bill. Next slide. Next slide, please. Okay, so this, not much here. So this just says that companies that are into joint arrangements are going to be taxed separately according to their equity stake. And we already talked about carry or finance arrangements. It doesn't alter the fact that each person is going to take home the equity stake of the capital allowances. So nobody's going to be claiming from somebody else. Next slide. Business restructurings, this is a very interesting part of the NTA. This deals with mergers and acquisitions. And I think the idea here is generally favorable to M&A activity in Nigeria because the government, I believe, is trying to incentivize divestments, from the majors to Nigerian independents or mid-caps. We've seen a lot of activity over the last few years. And so the government tried to make the rules simpler and the cost maybe cheaper. For example, there is no VAT on M&A activity going forward. And that easily shaves off 7.5% of whatever an acquisition price is supposed to be. So that's a good thing. Another thing to note here is that this NTA seems to favor what we call asset deal. You know, in M&A, you can either acquire an interest directly, which is an asset deal, or you acquire a company that holds the license, which is a share deal. This suggests that asset deals are more tax efficient, particularly if you are the buyer, because it means, for example, that you can claim capital allowances on your acquisition cost if it's an asset deal. If it's a share deal, you do not get capital allowances on share sales. So that's just one distinction. Asset deals appear to be more favorable compared to share deals under this NTA. Next slide. Okay, so this looks at gas and a few other priority sectors that the government is, putting a lot of incentives into to try to bring up to, a higher economic scale. Next slide. So if we talk about gas downstream, I think one of the things we've noticed is there seems to be another printer's error here, because some of us who have gas operations might be familiar with the incentives that SETA gives, accelerated capital allowances, 3-year tax holiday. This NTA deletes that section, those list of incentives completely, but it replaces it with something called a revised memorandum of understanding, MOU. Now, the problem is that it doesn't define what this revised MOU is. So as it stands today, there is this big lacuna for gas downstream operations. They don't know which incentives to apply. We've reached out to the committee as well. They said they're going to look at it or they're going to clarify. But it's something that brings unnecessary uncertainty, to, project economics, investor decisions and so forth. Next slide. Okay, so here the NTA just codifies one of these executive orders that the president signed in 2024. And I believe that's the one related to NAG, non-associated gas for onshore and shallow water. So it's now part of the body of the act. But something that is not in the act is the one on deep offshore. I think that was also passed in 2024. Deep offshore gas incentives are not in this NTA. And people are asking, so does it mean that there's no more deep offshore gas incentives? It's still a law, because it's a presidential order, but it's not of the same level as an act of the National Assembly, which this is. So I think something still needs to be done just to give more confidence to investors in deep offshore gas. Next slide. Okay, so this just says that companies operating in midstream, they now have a new filing requirement, which is to file their estimated tax returns before February 28th of the new year. A lot of us in PPT are already doing this, so I guess this is just cascading to LNG operators. Next slide. There's a lot going on in the free trade zone. We have refining and so many other activities going on there. Historically, we've also had a number of our activities on air. But what this is saying in essence is that as long as you continue to export outside Nigeria, you continue to enjoy the tax exemptions, tax-free sales. But if you are selling into Nigeria, then there is a proportional tax that you would have to pay, and but it says that from 1st of January 2028, that proportionality, is removed completely. So whether you sell 25% of your global sales into the Nigerian customs territory, or you sell only 1%, you are going to pay Nigerian tax. So a number of people think this reduces the investor appetite for free trade zones, because it's kind of suggesting that you should just focus 100% on exports, and that's not really good if you have a domestic need. Next slide. So the next slide will talk about this economic development tax incentive. So this replaces what we used to know as pioneer tax holiday, those 3 or 5 year holidays that companies maybe in gas or refining used to enjoy. So it just says that, so these incentives apply. Now, the problem with this EDTI is that even though the government gives you a 5-year holiday, if you are carrying out an approved activity, you still have to pay that 15% minimum tax we talked about that foreign affiliates have to pay. You still have to pay it as well as a Nigerian company. And a number of people are saying, why do you give me a tax holiday with one hand and you collect 15% tax on my profits in another hand? Now, when we had a conversation, OPTS had a conversation with Mr. Oyedele in October on this issue. He said it's here to stay. The 15% is not going to change because the government needs money to run, business of the government. So nobody's going to give you a tax holiday without you paying something back. So I think that's quite interesting. Next slide. So this will talk about, I'll say a potpourri of other taxes. The first will be stamp duty. Next slide. Stamp duty, maybe 1 or 2 years ago now, FIRS started giving a lot of attention to collecting stamp duty tax from companies. There was a lot of focus on oil and gas because a number of us started audits. And NTA is widening the net as far as stamp duty is concerned. So if you go to the next slide, NTA is saying that all Nigerian-related documents are liable to stamp duty. Now, in the past, we used to say that if you executed a Nigerian-related document offshore, maybe your board of directors or your chief executive flew to Japan to sign an FPSO agreement. Because it was signed offshore, it will not be liable to Nigerian stamp duty. Now, this is saying no more of that. As long as it is related to an asset in Nigeria, even if you sign it on the moon, you must come to Nigeria and pay the stamp duty. And then it clarifies who the payer of the stamp duty would be. So if you are the person or the party receiving the transferred interest, say you enter a PSC with the government, the PSC is giving you a right to exploit, right? So you are the receiver of the interest. You are the one to pay the stamp duty. So that's what this is saying. And you have to pay it within 30 days after you sign the contract or the agreement, otherwise penalties and interest would apply. Next slide. So fossil fuel surcharge, or what some people call climate change tax. This is just a 5% surcharge on fossil fuel products. Certain basic household type products are exempt, household kerosene, cooking gas, CNG, renewable energy, they are all exempt. But petrol, I don't think petrol is exempt. So, petrol is part of this 5% surcharge. It just increases our OPEX at the end of the day. I think there's not much anybody can do about it. Next slide. PAYE, I think this has been generating a lot of comments, particularly in our sector where everybody's tax is going to go up between maybe 2 to 5% or 2 to 6% additional increase because what the government has done is It tried to reduce the tax burden on lower earning sections of society. But if you are part of the proverbial 1%, then you are definitely going to pay more as payroll tax. There's something called deemed capitalization. So this is not really new. The only thing we'll just say here is that if you have a local or a foreign loan and the interest you are paying on that loan is higher than 30% of your EBITDA, then you would have to pay tax on the excess. In other words, that excess is not tax deductible. Next slide. And then finally, priority 10. So this is what we call transition, stabilization, and miscellaneous issues. So we'll just breeze through this quickly. If you go to the next slide, please. So you might have heard that input VAT for services, overheads, CapEx are now recoverable. That is true. It makes cash flow easier for a number of sectors of the economy, but that does not affect most of us in oil and gas, because most of our products in oil and gas, so whether it's our crude oil, our gas, feed gas, our exports, they are all VAT exempt. So that means if you have a VAT exempt product, you cannot recover or recoup your input VAT. So the best you can do is either just to expense it or to capitalize it, like we've all been doing. So I don't think there's any change in that for us. There is this new thing a number of our companies would already have maybe started. FRS is insisting that every company connects its ERP, so your Oracle, your SAP in the office, to the FRS portal, and that you are disclosing in real time your invoices. So whether it's your oil or gas sales or your purchases from your vendors, you're supposed to upload all that in real time, and the FRS can see it. It's supposed to give FRS transparency into our records, and hopefully reduce maybe audit disputes, years down the line, because FRS saw what we were doing in real time. Maybe the last thing I'll mention on this slide is that oil and gas companies, according to this NTA, are no longer required to withhold VAT when they are making purchases. I think this is also something that they are going to quickly clarify, because it was one way the government was making a lot of money. Oil and gas companies were all goldfish. So when we withhold VAT on our purchases and remit to government, it's easier compared to if government was chasing some vendor somewhere to collect that VAT. So I think they are going to rectify it, and they're going to mandate us to continue with the current state of play. Next slide. Okay, so PSC, Fiscal Stabilization Clause post-PIA, has now been removed. So there's uniformity of PSCs, whether pre or post-PIA. Companies are now mandated to voluntarily disclose any tax planning ideas that they are carrying out to the government. So no more secrecy. You can't go and call a Big Four firm and they give you ideas on incentives you need to claim. No. This is saying that you have to take that report or some kind of summary to the government to self-disclose. I think that's interesting, but we've seen it in a number of other jurisdictions. So Nigeria is not really new. Next slide. Yeah, we can go to the next slide. Okay, so what does this all mean? We've seen what some of these risks are. We've seen that it's going to increase our tax bill, it's going to increase our compliance efforts. For some of it, it's maybe even going to change our business structure, our corporate structure, our group structure. So what do we do? How can we mitigate and reduce the bill so that our profits are slightly better off. Next slide. Okay, I don't know. Can you see the slides?
No, sir.
Okay, so it seems that the write-ups in each of the slides from mitigation strategies, you can't see them. So you can't see anything written here.
Yes, nothing is written there.
Okay, can you allow me to share, and I'll share my own slides over here. We'll just start from here, if that's okay.
Yes, sir. So a reminder, you have 3 minutes left.
No problem. I think we are doing fairly good on time. So let me know when it's good for me to share, please. Okay, let me know if you can see my slides, please.
Yes, sir.
Yes,
Yes, we can.
Yes, sir.
All right, perfect. So first of all, we know that the reforms are irreversible. The government has put so much energy into this. And so fiscal certainty tomorrow depends on what we are able to do today. We don't have years, we have just weeks and days. So by way of mitigation strategies, I think for the one that talks about residency, the main thing for us is we have to strengthen what I call our offshore economic substance protocols. So what I mean is if you have foreign entities that are being effectively controlled from Nigeria, you have to divorce that control and try to create some substance in maybe a BVI or a Bermuda. Now, some of what we've seen in practice is you have to appoint locally resident directors. So directors who are resident in Bermuda, you have to find them. You have to get auditors, audit firms who are resident there as well. You have to get company secretaries resident there. You have to hold your board meetings outside of Nigeria. And the minutes would reflect that, that took place maybe in Bermuda or Jersey, as the case may be. But you have to take that out from Nigeria. Now, the tax authorities, when you do this, have typically accepted that as a way to ensure that that foreign entity doesn't come into Nigeria to pay full Nigerian taxes. For capital allowances, I think the only thing I would say here is ensure that you pay your VAT and your import duty and that you maintain the adequate records. Royalty, if we know that we are likely to face an FIRS audit, maybe dating back 10 years, then we just have to keep proper records, our production data, our FOP, fiscal oil price or fiscal gas price, whatever was the basis of our royalty payments. And we need to automate our royalty compliance the same way you pay your VAT before 14 days of the new month, you have to do the same for royalty. Transaction tax, this is going to increase, everyone's tax. But I think the main thing is to go back, review your contracts, identify the ones that give you some kind of exposure. Which one can you push to the vendor? Which one do you have to bear? Make that assessment, make a provision, make a payment, and comply. For HCT, PPT. I think the main thing here is just to keep your distinct ledgers. If you are an entity that pays, these different taxes, make sure that your documentations are separated.
Justice.
Okay. For D&A, we said that if you do not put at least 30% in a local bank in Nigeria, then that tax, that contribution is not allowed for tax purposes. So obviously you have to agree with your partners, in your governance meetings, your FinCom, on what, how you're going to choose the local domiciliation bank, and to make sure that you keep your bank records as well so that you can easily demonstrate that at least 30% was kept with them. Consolidation and segregation, make sure you keep ring-fenced accounts on a per license basis. Even if you are going to consolidate, ultimately, always have very granular information. And a number of us are already operators. A number of us have multiple ventures. So things like cost allocation is normal to us. We all have policies that dictate things like this. Just make sure that they are tight. Your GL postings in your accounts are very separated. In terms of gas and priority sectors, we definitely need the regulators to clarify the revised incentives, especially those gas ones that were deleted. If you are in an FTZ, a free trade zone, make sure you are separating your exports from your domestic operations and keep books appropriately. Other taxes, stamp duty, we can't run away from it. Pay the stamp duty, expense it, claim a tax deduction. For PAYE, there's a number of discussions people are privately having in different organizations. I'm aware that Pengassan is involved in a few of them. I think the main thing is to engage with management, and see what is possible. Some folks are saying, does the company bear it? Do the individuals bear it? Do we meet somewhere in the middle? What's the modality? That's a conversation that is ongoing. But either way, even if the company bears it, it's tax deductible. Transition and miscellaneous, ensure you classify your VAT correctly. You have to integrate your ERPs with this FRS portal, this thing called e-invoicing. I think they gave a 1st of November deadline, but I'm sure they would allow folks to do that before the end of this year. So let's make sure it is done. In terms of next steps, internal readiness, we have to begin to look again at our contracts, our tax processes, trainings on these new compliance rules, and these types of sessions are pretty important. Knowledge sharing, talk to your peers in other companies. As long as there is no antitrust situation, you can talk, what are you doing? How are you handling this? Policy advocacy is important. Engage with industry groups, so the IPPGs, the OPTS, speak of course with MOF, FRS, sit down with them, have a conversation. Collaboration is important, these types of roundtable discussions. So the takeaways, the reforms are here to stay. There's not much we can do about it. You either adapt or you risk losing value. And readiness, it's in the air. The reforms, it's in social media, it's on AIT, it's on Arise. So it's now a strategic issue that every company needs to address. It's not just for the accountants. It is enterprise-wide, and that kind of enterprise-wide thinking is important. Get folks in the room, the technical guys, the finance people, the legal, the commercial, and let's see how we can align our systems. Early action is important. We don't have a lot of time, but better late than never. Scenario modeling, look again at your project economics, see how these new tax laws impact your profitability, your IRR. Collaboration is important, even beyond, our typical engagement. So there's no reason why you shouldn't also be talking to ICANN or CITN, anybody who can be a comrade to advance the corporate interest. Thank you so much. I hope that was useful. Thank you for your attention. I'm happy to take your questions.
Thank you, Ezinegbe Aibangi, for that very, very detailed lecture. Ladies and gentlemen, we have 5 minutes for questions. So please, if you want to ask a question, can you raise your hands or you drop the questions at the chat box? We would be taking only 2 questions. And if you have more questions, feel free to send him a message on LinkedIn or an email to him. So please, questions, please. We would like to read the questions on the chat box, or you raise your hands and we would give you the opportunity. Okay, Nwankwo, please unmute your mic and ask a question. That's our Assistant Diversity and Inclusion Chair. Okay, over to you, sir.
Okay, thank you very much, sir, for the detailed presentation. Indeed, this is the first detailed presentation I'm getting on this tax bill and what it entails. So the first observation I had was where you captured, gas processing under upstream operation, but specifically, my question goes to, when you mentioned about separation of entities, which is in the PIA, which is also captured in the new tax act. So my first question is, are there advantages to this, especially in respect to tax-wise, number one? And then the number two is, especially citing the example you gave, I also want to probably understand the role of parent companies, because when you mentioned about integrated strategic projects and you wanted to use, or you used the NNPC as an example, so the AKK, from what I know, is being done by one of the subsidiary agencies of NNPC. And then the upstream is also being carried out by a separate entity. So my understanding is that NNPC Limited as itself is like a parent or holding company to so many companies. So are you saying that subsidiary companies can, do those, I don't know, for lack of better word, cross-posting of just to align with the tax? And then the third one also, being that you're an expert in the tax, being that under the PIA especially, and maybe going forward, that NNPC have also become a limited liability company. That's what the PIA envisages. So when you say some of the, JV, PSC between government and the company. So I've always struggled with that question. So are you saying that NNPC as, so how do you position NNPC, which is a limited liability company, in quotes, to also be attributed to government shares? Does those shares go into NNPC account as a private company, or it goes into federation account? I think those are my 3 questions. Thank you.
Okay. Thank you very much, Mr. Nwankwo. I think those are very, very salient questions. So let's start with the one you talked about, separation of entities, whether there are any advantages related to it. Well, so we know that upstream, mid and downstream have fairly different tax regimes, right? So our upstream is, our usual PPT or hydrocarbon tax, and of course we pay CIT, and then mid and downstream are purely CIT. So if we separated those entities, so what does it mean? Now, the reason why the government separated them under PIA was that it wanted to give more fiscal attention, particularly to gas, and in particular, non-associated gas. Because what they found out is that, a number of upstream companies who have AG or maybe even NAG related to them commingle, and that means that even though they can use, the expenses incurred in gas to reduce their profits for purposes of upstream taxation. right? And the government found out that that was, so the upstream companies already had that undue advantage, in quotes, compared to a purely NAG company, that didn't have the opportunities of the huge profits that it needed to reduce. So they said, no, you have to split it, and it's good for maybe visibility as far as the government is concerned. So, but I think that there's more advantage, if you're an integrated company, there's more advantage in putting everything under one roof, because you don't need to wait for when the revenues from one particular stream to start coming in. You can easily begin to offset it, right away from the profits you are getting from another stream. So that brings us to the question you asked on ISPs and the role of parent companies. You are right. We still don't have the concept of group taxation in Nigeria. So what that means is that if a supposed ISP company still has different legal entities that are running the different streams, then it would not be able to really bring them together. But if it had just one legal umbrella and the divisions within that umbrella were carrying out those activities, then it can put everything in one pot and claim the cost deductions. But you're right, there's no group tax concept in Nigeria. The third question you asked was with respect to NNPC. So now that they're a commercial entity, under CAMA, what does that mean? Well, I know that FRS has begun to look at NNPC like they look at any other, operator in the sector. The only difference is that their shareholders are government entities, MOPI and MOFI, that's all. But NNPC pays royalty like everybody else. NNPC pays tax. As a matter of fact, I think NNPC are the largest taxpayer in the country right now. But as it stands today, I think they are still the government's spearhead as far as the PSCs are concerned, or maybe the JVs. So that's where it is today. There's still a little bit of culture, change going on there. I think that would take time. But as it stands today, they are a taxpayer like everybody else. Thank you.
And the last question is from David Agidi. He's on the chat. How does government make money from asset sale versus share sale in M&A if they do not collect VAT or CGT from such transaction?
Yeah, thank you so much, Doctor. That's also a very important point, and I greet you, sir. So how does government make money from asset sale or share sale if they are not collecting VAT? So government makes money through the other taxes and levies that follow any divestment deal. Number one, of course, is your capital gains tax, which is a seller's tax. So if you bought at 100 and you are selling at 150, you pay CGT now at 30% on the differential, the 50. So that's one. Two, you have transaction taxes like ministerial consents. I think that is now 7% of whatever the headline acquisition cost is, and that goes to NUPLC. So that's also government. Three, stamp duty. Most asset sales, I would say virtually all asset sales, are what you call deed of conveyance under the stamp duty law. And that's an additional 1.5% of the headline acquisition price. So just these three alone suggests to me that nothing less than 9%, even more if you add the CGT, nothing less than 9% of whatever the value of that deal is coming to the government. Those days, that could have been a 16% with the VAT, but no more VAT, so it's probably 9-10% or even more if we factor in the CGT impact. So government still makes money, no question about that.
Thank you, sir. Thank you, sir. Dr. David Agidi, I hope he's answered your questions. Please, you can stop sharing. Thank you. Please, can we give our speaker some virtual applause? Yes, can we give some virtual applause for taking our time to, please, you can drop some comments appreciating His Excellence delivery today. So, ladies and gentlemen, we wrap up the event with a few announcements. First of all, if you're not a member of SPE, please, we advise that you join SPE. We have several professional benefits and, of course, student members benefits. Becoming a member of SPE is 77,500 and membership renewal is about 62,500 naira. Actually, these membership fees have just been reduced. So please ensure you take very good use of this opportunity and renew before 1st January 2026. Failure to renew before 1st of January 2026 would mean that you would pay a reinstatement fee of 15,000 naira. So please ensure you try and renew before the 31st of December. The account details is on your screen. All you need to do is to take a screenshot and then send a message to our membership J's on the call, Engineer Dr. Ogenerome Ogolo, and he would assist you. All our events, and even this event is live streamed on our social media platforms. You can always visit us on Instagram, LinkedIn, Facebook, Twitter, now called X, and be rest assured that we would respond to your inquiries and messages. Of course, you'll see all of our events adverts on these social media pages. We also appeal that you can always visit our YouTube so that you can have past events where you refresh your memories. We are announcing that NICE 2026 will hold from the 3rd to 5th of August 2026, and we are calling for abstracts. We would love to share your technical papers about key information in the oil and gas industry. Please ensure you send in your abstract before the deadline, which will be on January 9th, 2026. I'm asked to inform all of our members that there would be no extension of abstract. So please ensure you send your abstracts before 9 January 2026. Ladies and gentlemen, we wrap up the event with a closing remark from our program's chair. Please help me welcome Professor Kafaya Zademi as she gives her remarks. Over to you, Prof.
Good evening once again, everyone on the call. And thank you for joining us this November for our monthly technical meeting. To our speaker, thank you so much for taking us through the topic, preparing for Nigeria's 2025 tax reforms, the 10 strategic priority areas for oil and gas companies, in which you did analyze the key features for each of the priorities, the fiscal regime, as well as you talked about the impact and the risk. I guess some of us that are not in the tax field are into the academia will need some more time to look at those slides and comprehend very well. We thank you for your time, creating that time to come talk to us and share your expertise. And then to the board members, thank you for always putting in all your best to see that we deliver on all our activities. And to all participants, thanks for joining, and we hope for our next month technical meeting also you'll be part of it, where we share knowledge in technology and all that helps us operate well, fully informed in the oil and gas sector. Thank you so much and have a very good evening.
Thank you, ma'am, for that remarks. Ladies and gentlemen, please, we'd like to appeal that you turn on your video cameras. Let's have some shots. Please turn on your video cameras. Let's do a shot. Please turn on your video cameras. Thank you, thank you, thank you. I love to see your very amazing and beautiful faces. Thank you. Our assistant program chair, Dr. Malami Mohammed. I'd like to see your face. Our membership chair, Dr. Ogene Rume, would like to see your face. Our amazing immediate past council chairman and section director, Amina Damadami, would love to see your face. Would like to see the face of a publicity secretary, Odafe. Nafisa would like to see your face. Igwe Justice would like to see your face. Ugochi. All the board members of the call would like to see your face, please. When I say SPE, all you need to do is respond with culture of excellence. When I say SPE Abuja, you give me a smile, a thumbs up, and you respond with culture of excellence. When I say SPE Abuja, respond with a smile, a thumbs up,
Culture.
and it's a culture of excellence. Are you ready? SPE Abuja.
Culture of excellence.
Excellence.
You're not smiling. You're not smiling. Okay, one call. SPE Abuja.
Culture of excellence.
Culture of excellence.
Culture of excellence.
Thank you, ladies and gentlemen. Thank you. Thank you. And bye for now. A few minutes for networking, and we are done for now. Thank you.